Emergency protocols are active right now in bank boardrooms across New York, London, and Frankfurt. Not because of interest rates, not because of inflation, not because of any traditional financial crisis, because China just executed a move so calculated, so devastating, so perfectly timed that it's forcing the entire Western banking system into survival mode. Ladies and gentlemen, Asian guy here. What Beijing announced at 2:30 a.m., their time yesterday, wasn't just policy adjustment, it wasn't just regulatory change, it was financial warfare. A surgical strike against the pressure points of Western finance that proves China has been studying their enemies' weaknesses for years and finally decided to exploit them all at once. The announcement sounds bureaucratic, technical. The People's Bank of China issued new guidelines for cross-border yuan settlement optimization and strategic reserve management enhancement. Boring regulatory language. Except when you decode what those phrases actually mean, when you understand the mechanics they're implementing, you realize China just declared independence from the Western financial system while simultaneously destroying its liquidity foundations. Here's what they actually did. China terminated dollar-based settlement requirements for all commodity transactions with partner nations. No more dollars needed to buy Chinese goods. No more dollars needed to sell commodities to China. The world's largest importer and second largest exporter just unplugged from the dollar system that has dominated global trade for 70 years. But that's just the opening move. China simultaneously activated alternative payment channels they've been building in secret for the past 5 years. Bilateral currency swap agreements with 47 nations went live instantly. Digital yuan cross-border pilot programs expanded to operational status overnight. Alternative messaging systems bypassing SWIFT became mandatory for all Chinese financial institutions. The timing is surgical. This announcement came exactly as Western banks are drowning in the credibility crisis we documented last week. Institutions that lost trust with their own customers suddenly discovered their largest counterparty just cut their financial lifelines. Banks that were struggling to maintain contradictory public positions while executing private survival strategies just lost access to the world's most critical market. Western banks built their international operations on a simple assumption. China would remain integrated into dollar-based systems regardless of political tensions because integration benefited everyone. That assumption just died. China demonstrated they've prepared comprehensive alternatives to every Western financial service. They don't need Western banks anymore, but Western banks desperately need them. The immediate impact is visible in emergency lending markets. Dollar funding rates spiked as banks realized Chinese institutions would no longer provide dollar liquidity through traditional channels. European banks that relied on Chinese deposits to manage their funding gaps discovered those deposits were being recalled to domestic Chinese institutions. American regional banks that depended on Chinese trade financing found their credit facilities terminated without notice. JP Morgan Chase activated crisis protocols within hours of the Chinese announcement. Their Asia-Pacific operations were hemorrhaging liquidity as Chinese counterparties executed pre-planned withdrawals from dollar-based arrangements. Their commodity trading desk found itself holding massive dollar-denominated positions with no Chinese buyers willing to accept dollar settlement. Their foreign exchange operations faced unprecedented demands for yuan conversion, with no Chinese institutions willing to provide traditional swap services. Goldman Sachs discovered their international arbitrage strategies depended critically on Chinese market access that no longer existed under the new guidelines. Currency hedging operations that generated billions in annual revenue suddenly faced Chinese counterparties demanding settlement in yuan rather than dollars. Investment banking relationships built over decades were terminated as Chinese institutions activated alternative arrangements with non-Western partners. Bank of America's corporate lending division found itself in immediate crisis as multinational clients demanded emergency credit facilities to replace Chinese financing that disappeared overnight. Manufacturing companies that relied on Chinese suppliers discovered their payment systems no longer functioned under the new settlement requirements. Technology companies that operated Chinese subsidiaries found their internal cash management systems suddenly incompatible with Chinese banking regulations. The European response was panic disguised as coordination. The European Central Bank convened emergency sessions to address the immediate liquidity shortfall created by Chinese withdrawal from euro-based settlement systems. Deutsche Bank, BNP Paribas, and Credit Suisse simultaneously activated emergency funding protocols as their Asian operations lost access to Chinese financial infrastructure. But the European banks face a problem more severe than their American counterparts. European institutions became more dependent on Chinese relationships during the period when American banks were reducing Chinese exposure due to political pressures. The Europeans thought they were gaining competitive advantage. Instead, they made themselves more vulnerable to exactly the systematic withdrawal China just executed. The Bank of England discovered that London's position as a global financial center depended more heavily on Chinese participation than anyone had calculated. Chinese institutions weren't just customers of London's financial services. They were infrastructure partners whose participation enabled London's operations to function efficiently. Without Chinese counterparties, London's clearing systems are experiencing unprecedented stress. Swiss banks, already isolated by their decision to terminate swap agreements with other central banks, found themselves completely cut off from Asian markets as Chinese institutions classified Switzerland as a non-cooperative jurisdiction under the new guidelines. The Swiss bet on isolation to protect themselves from Western financial contagion. Instead, they isolated themselves from the Eastern alternatives to Western systems. The Federal Reserve's response reveals the desperation of Western monetary authorities. Emergency swap line activations with European and Asian allies attempted to replace Chinese dollar liquidity. But the mathematics don't work. China's withdrawal from dollar markets creates liquidity gaps that exceed the Fed's capacity to fill without triggering domestic inflation. They're trying to replace the world's largest economy with printing press operations. The Bank of Japan faced immediate currency crisis as Chinese institutions dumped yen-denominated assets to comply with new domestic regulations, prioritizing yuan-based reserves. Japanese banks that had positioned themselves as intermediaries between Chinese and Western markets discovered both sides of their business model had been eliminated overnight. The Australian banking system went into crisis mode as Chinese commodity purchases, the foundation of Australia's export economy, shifted to yuan-based settlement systems that Australian banks cannot access under current regulatory frameworks. The Reserve Bank of Australia activated emergency protocols to prevent domestic bank failures caused by the sudden loss of Chinese-related trade financing. But the most devastating impact is hitting the global commodity markets. China didn't just change payment systems. They restructured the entire commodity trading ecosystem. New Chinese commodity exchanges operating exclusively in yuan began pricing oil, metals, and agricultural products independently of Western benchmarks. Alternative supply chains bypassing Western financial infrastructure became operational overnight. Oil markets experienced immediate disruption as Chinese refiners shifted to yuan-based purchasing through direct bilateral agreements with producing nations. OPEC members discovered they could bypass dollar-based oil markets entirely by selling directly to Chinese buyers using yuan settlement. The petrodollar system that has anchored American financial dominance since the 1970s just lost its largest customer. Gold and silver markets exploded as Chinese institutions began massive accumulation programs using newly available yuan liquidity that was previously committed to dollar-based operations. Physical metal disappeared from Western markets as Chinese buyers, no longer constrained by dollar conversion requirements, purchased everything available at any price. The precious metals shortage we've been tracking just became a crisis. Agricultural markets faced disruption as Chinese food importers activated alternative payment systems for grain, meat, and dairy purchases from South American and African suppliers. American agricultural exporters discovered their Chinese customers had disappeared overnight, replaced by yuan-based purchasing agreements that American firms cannot access. The corporate impact extends far beyond banking. Multinational corporations that built global operations, assuming continued Chinese integration into Western financial systems, discovered their entire business models were suddenly obsolete. Supply chains, optimized for dollar-based transactions, couldn't adapt quickly enough to yuan-based requirements. Apple found that their Chinese operations, previously integrated seamlessly with global cash management systems, were suddenly isolated by new banking regulations requiring domestic yuan settlement. Microsoft discovered their Chinese partnerships required restructuring to comply with yuan-based transaction requirements that their Western accounting systems couldn't accommodate. Amazon's Chinese logistics operations became stranded assets as yuan settlement requirements prevented integration with global fulfillment networks. The technology sector faced additional pressure as Chinese firms activated alternative arrangements with non-Western partners for critical services previously provided by American companies. Cloud computing contracts were transferred to domestic Chinese providers. Financial technology partnerships were terminated in favor of yuan-based alternatives. Research and development collaborations were restructured to eliminate dollar-denominated transactions. But the Chinese strategy reveals sophistication that suggests years of preparation for exactly this scenario. Alternative infrastructure wasn't built reactively in response to Western financial pressure. It was built proactively to enable complete independence when strategically advantageous. China wasn't pushed out of Western systems. They chose to exit when exit would cause maximum damage to Western interests. Intelligence analysis of Chinese financial infrastructure development over the past 5 years shows systematic preparation for Western financial independence. Digital yuan pilot programs weren't experiments. They were operational tests of systems designed to replace SWIFT messaging, dollar clearing, and Western banking services. Bilateral swap agreements weren't diplomatic gestures. They were foundation construction for alternative monetary arrangements. The sophistication of Chinese preparation extends to psychological warfare components designed to maximize Western panic during the transition. Chinese financial institutions were instructed to execute withdrawals from Western systems using specific timing patterns calculated to trigger maximum algorithmic trading responses. Currency conversion operations were coordinated to create artificial volatility spikes in dollar markets during periods when Western banks had minimal liquidity buffers. Internal Chinese banking communications, intercepted by Western intelligence agencies, reveal detailed planning for exploiting specific Western institutional weaknesses identified through years of financial relationship intelligence gathering. Chinese institutions mapped the dependency networks of every major Western bank, identifying critical pressure points where Chinese withdrawal would cause maximum operational disruption with minimal Chinese cost. The Chinese strategy included a preparation for predictable Western responses to their independence declaration. Alternative arrangements were established with Russian, Iranian, and other sanctioned entities, specifically to demonstrate that Western financial retaliation would only accelerate the development of competing financial ecosystems. Chinese planners wanted Western sanctions because sanctions would force fence-sitting nations to choose sides, and the Chinese system was designed to be more attractive than Western alternatives. Economic warfare specialists within the People's Liberation Army contributed tactical elements to the financial independence strategy. Military analysts identified Western financial vulnerabilities that could be exploited without triggering military responses. The timing, coordination, and execution of Chinese financial independence followed military operational planning protocols rather than traditional economic policy development processes. The Chinese preparation also included sophisticated disinformation campaigns designed to obscure the true scale and timeline of their alternative system development. Western intelligence agencies were fed false information about Chinese financial infrastructure capabilities, leading to systematic underestimation of Chinese preparedness for Western financial independence. Western financial institutions made strategic decisions based on incomplete and deliberately misleading intelligence about Chinese alternatives. But the most devastating aspect of Chinese preparation involved recruiting Western financial expertise to design systems specifically optimized for replacing Western financial infrastructure. Former employees of J.P. Morgan, Goldman Sachs, and Federal Reserve banks were hired through intermediary consulting firms to provide detailed technical specifications for Chinese systems intended to make Western services obsolete. These recruited Western experts provided Chinese developers with insider knowledge of Western financial system vulnerabilities, regulatory loopholes, and operational dependencies that Chinese alternatives could exploit. The yuan-based payment systems weren't just Chinese innovations. They were Western financial expertise turned against Western financial interests by Chinese strategic planning. The recruitment campaign extended to current employees of Western financial institutions who were offered lucrative consulting contracts to provide real-time intelligence about Western financial system stress points. Chinese financial intelligence operations identified Western bank employees who had access to crisis management protocols, liquidity management systems, and emergency response procedures. These employees were systematically compromised through financial incentives and professional opportunities. The result was Chinese financial independence designed with perfect knowledge of how Western financial institutions would respond to Chinese withdrawal. Every Western reaction was anticipated, planned for, and prepared to be exploited for further Chinese advantage. Western banks didn't just lose access to Chinese markets, they lost access to markets that had been specifically designed to punish their predictable responses to Chinese independence. The timeline for Chinese preparation suggests intelligence assessments that correctly predicted Western financial system instability. Chinese alternatives were completed and tested exactly as Western banks entered their current credibility crisis. The coordination isn't coincidental. China recognized Western weakness and timed their independence declaration to maximize Western vulnerability. The geopolitical implications are immediate and severe. American financial sanctions, previously the ultimate enforcement mechanism for international compliance, became irrelevant overnight. Countries that faced American financial pressure can now access Chinese alternatives that provide equivalent services without American oversight or interference. Russia, already partially isolated from Western financial systems, found itself perfectly positioned to benefit from Chinese independence. Existing Russian-Chinese financial arrangements became templates for other nations seeking alternatives to Western financial control. Energy transactions, commodity trades, and capital flows that were previously forced through Western channels found alternative pathways through Eastern systems. Iran discovered that Chinese yuan systems provided complete alternatives to Western banking that had been closed by sanctions. Years of forced adaptation to non-Western financial systems created operational advantages when Chinese alternatives became fully available. What appeared to be Iranian isolation became Iranian independence. The European Union faces an impossible choice: They can attempt to maintain traditional relationships with American financial systems while losing access to Chinese markets. Or they can develop independent relationships with Chinese alternatives while risking American financial retaliation. The choice between American and Chinese financial systems is becoming binary. Individual European nations are already making that choice. Germany's largest banks are privately negotiating yuan-based arrangements to maintain access to Chinese markets. French institutions are exploring alternative payment systems that bypass American oversight. Italian banks are considering Chinese partnership agreements that would reduce dependence on American financial infrastructure. The United Kingdom's post-Brexit strategy of maintaining financial service competitiveness through Chinese relationships just became impossible. Chinese institutions that used London as a gateway to Western markets no longer need Western market access. London's value proposition as a bridge between East and West disappeared when the East decided independence was preferable to integration. The Federal Reserve faces a scenario they never planned for. Their monetary policy tools were designed for a world where American financial dominance was unquestioned and alternatives were ineffective. Chinese yuan systems that actually work, that provide real alternatives to dollar-based services, that can operate independently of American oversight, represent an existential threat to American monetary authority. The response from American financial authorities has been predictably desperate. Emergency protocols to prevent further Chinese withdrawal, threats of enhanced sanctions against institutions that cooperate with Chinese alternatives, diplomatic pressure on allied nations to reject Chinese financial partnerships. But these responses only validate Chinese strategy by demonstrating American financial desperation. The timeline for Western adaptation to Chinese independence is measured in months, not years. Banks that cannot quickly establish yuan-based operational capabilities will lose access to the world's largest market permanently. Corporations that cannot restructure their Chinese operations for yuan settlement will find themselves replaced by competitors who can adapt faster. But adaptation requires more than technical capability. It requires abandoning the assumption of Western financial superiority that has guided institutional strategy for decades. Western banks must accept subordinate status in Chinese systems they previously expected to dominate. Western corporations must operate according to Chinese financial regulations they previously expected to influence. The emergency mode that Western banks entered yesterday is permanent, not temporary crisis management requiring short-term solutions. Permanent operational change requiring fundamental restructuring of international banking relationships. The world that existed before China's latest move is gone forever. What replaces it depends on how quickly Western institutions can adapt to Eastern financial dominance. China's latest move isn't forcing banks into emergency mode. It's forcing them to recognize that emergency mode is now permanent because the system they depended on just chose to exist without them.